The numbers have kind of topped off, so let's go ahead and get started. This is investments, getting started with our partner, Bank of America. Our presenter tonight is Reed Achille. He is a vice president and strategic execution lead at the Bank of America Private Bank, who joined the firm in September of 2007. He has over 24 years of investment experience supporting the needs of high net worth individuals and their families, as well as charitable organizations. He earned his bachelor's degree in 2003 with financial planning from the University of North Texas, Bowling Green. Reed is a certified financial planner certificate, a designation awarded by the Certified Financial Planner Board of Standards Incorporated to him in 2006. Take it away. Teach us about invest.
Excellent. Thank you so much for having me. I appreciate it. So my entire career in banking has been in managing investments, all the way up, as she had said, from individual investments to large corporations and nonprofits. So the biggest question that I get with investments is, how do I get started? And before you get started, it's best to think about why you want to invest. So in general, investing helps you reach your growth. It helps grow your money faster, especially over the longer term. So if we look at this chart and think about a hypothetical $10,000, you just hit that scratcher, right? You got $10,000 in your hand. If you invest it, depending on the vehicles that you use, it grows differently over time. So looking at these examples, if you still held onto that $10,000 5 years later, you would still have $10,000 in your hand. I know savings accounts are paying a little bit more than the 1% here, but for the sake of this illustration, and for the last 6 or 7 years, they've been pretty low. But if you made 1% interest in a savings account over 5 years, that $10,000 would grow to $10,500. So not the best, but still more than the 10,000 you have. But people invest for that higher annual return. So a good long-term average rate of return in the stock market is about 7%. So if you invested in the stock market for 7% over 5 years, that $10,000 would have grown to $14,000, almost $14,200. So again, not significantly more, but think about percentage-wise, 1,400 is about 40% more, right? So you get more money. Then obviously looking over 20 years, if you didn't do anything with it, that $10,000 would still be worth $10,000. If you were in the same 1% savings account, it would be a little bit more, $12,200. But over 20 years at 7%, you would have increased your money 4 times. So that $10,000 would have grown to $40,000. So that's why people invest, is because it grows your money at a higher rate of return over a longer period of time. Now, what else should you know before investing? Investing also involves volatility. With that $10,000 in your hand, the only way it gets smaller is if you spend the $10,000, right? The 1%, like money market rates of return, they're always 1%, but they're always 1% because they're always going to be 1%. There's not a lot of volatility. What comes with that 7% rate of return is what's known as volatility. And as you see here, this is the last 22 years of the stock market, right? And so if on January 1st, 2000, I said, hey, we are going to see a significant portion of the market implode with tech stocks. Then we're going to go to war after having the first attack on American soil ever. Then we're going to have the largest recession and price decrease ever in the stock market. And then at the end of it, we are going to have a global pandemic that shuts down the world for 2 years. Who would be ready to sign up and say, get me into that? Not a lot of people, right? But the chart that you can see there is the S&P 500. So despite all of that negativity, even with the recent negativity of the pandemic, we are still significantly higher than the S&P was on January 1st, 2000. So the trick with volatility, and as you can see over this chart, it's a 22-year chart. The trick with volatility is time, right? You need to be able to wait out the volatility. There has never been a 10-year period that the stock market return was negative, even in light of all these. Now, it's been close, right? It's been close. Sometimes it's been flat, but it's never been negative. But obviously, you can see it here, like right here, 2020 to 2010, it is slightly higher. It wouldn't have been a great return, but again, 3 major market catastrophes in that 10-year period, and you still would have made money, right? So volatility, it's what allows for the higher return, right? There's no such thing as no return without taking on risk. When you hear about stock market risk, really what they're talking about is volatility. So the other thing that we say, and as we looked at the other chart, I talked about all those huge downturns. You always want to avoid timing the market. I know a lot of people have heard, oh, well, I'm going to wait for it to just get a little bit better, or now's not the right time, or let me take my money out and put it into cash because I'm afraid of it going down. Well, so what this chart shows here is the last 31 and a half years of market performance. If you stayed invested every single day for that 31 and a half years, you would have seen a 9.8% annualized return. If you miss the best 5 days out of that 31 and a half years, your return drops by 1.5% to 8.3%. That's 5 days. Do you know what the best 5 days over the last 31 and a half years were in the stock market? And did you know the day before? So you got to stay invested. If you miss 10 days, it goes down to 7.2. And then obviously all the way down to the right, 1 month that is missing the best 30 days of stock market performance over the last 31 and a half years cuts your return to 4% annualized. That is missing 30 days. So what we always say is the stock market is a long-term investment strategy. We'd never encourage investing in the stock market for a short period of time. Again, the trade-off being the volatility. We saw the chart on the other side. You don't know when the best days are going to be. You don't know when the worst days are going to be. So if your time horizon and your risk tolerance doesn't match up, with these type of figures that you're seeing, it's potentially best to look for other types of investments. This obviously is just talking about stock market investments, not all investments total. And we'll talk about those other investments a little bit later as well. What could you invest in, right? So we saw that the stock market is the best place to get larger returns over long periods of time, but obviously comes with volatility. So there's multiple different things that you can invest in. And that's obviously what is recommended is a good asset allocation. A lot of people have probably heard the phrase, don't put all your eggs in one basket. And this is what that means financially, is that you want to look at what different options you have available to you, what your time frame is, what your risk tolerance is, and then pick the best mix of those investments to help you meet your goals over that period of time. So when you look into investing, the first thing that you need to do is determine what your goals are, what your time horizon is, and then liquidity needs. When are you going to need that money, right? So if you need money pretty quickly, I would never recommend investing in the stock market hoping to get a bunch of money real quick, right? Because just like you don't know when the best days are going to be, you don't know when the worst days are going to be. We don't know when that's going to happen. So if you have a short period of time, it's best to have that money that you need available using some of the less volatile investment strategies. But the longer time you have, the better it is to hold more stock market investment. So looking at this arrow chart here on the bottom, if your time frame is 1 to 5 years, you don't really have a whole lot of time to be able to wait out the market volatility. Again, if we think back to the Great Recession, 2008, that was a 3-year period. If 3 of those years are negative performance years, it's going to be really tough to get even back up to even in the remaining 2 years. And that's if you take all 5 years of that short-term time frame. So if your time frame is really short, if you want to invest in the stock market, I would not recommend a significant portion of your money going into the stock market because, again, there's that risk. 5 to 10 years, that's really when we start talking about is a good time to start looking at stock market investments. Some of you might have heard the term market cycle. A typical market cycle lasts 7 to 10 years. So if your time frame is 5 to 10 years, that gives you good time to wait out one full market cycle. Like I said, the stock market has never been negative over a 10-year period. So at worst, you would be right about even if you rode out all that volatility. Again, not what you want when you hear long-term returns is 7%. But you wouldn't have lost money. When you're talking about over 10 years, with over 10 years and the effects of inflation, if your time frame is 10 years plus, you want to have some money invested in the stock market. Because again, number one, that higher rate of return over time. And the only way to beat the effects of inflation, I'm sure we've all seen it recently. I don't know, the last time I was at the grocery store, I think I got 2 plastic bags worth of stuff and it was $70. There was no meat, there was no milk, right? I mean, it was crazy, right? So if you think about it, particularly as you get towards the older retirement years, the only way to have enough money to work for you, especially as we're hearing all of these worries about, oh, Social Security might not be there. I mean, I'm 45 and they're already telling me Social Security might not be there, and it's supposed to be right around the corner for me. So I need to have money invested in the stock market so that over the next 20 years, I get my best shot at trying to make as much money as possible. But that being said, your risk tolerance as well. I like to call this one sleep factor, right? So like we saw on that chart back a few slides ago, volatility can get pretty intense, right? And so I know that the market's going to come back. I also know that my time horizon is 20 years. So volatility really doesn't bother me all that much. Most of my money that I'm saving for retirement. I don't have access to it right now. I don't want access to it right now. So knowing that I have still another 20 years in front of me with the ups and downs, they don't bother me all that much. Like, sure, I get concerned if there's significant bad days or bad years, but knowing that I have a lot more time to make it up, it doesn't bother me all that much. That being said, I know some people that have 30 or 40-year investment horizons that cannot stand to see, you know, a very small down day on the market. So if it's going to keep you up thinking that you're going to lose all your money, right? That's where you would have a lower risk tolerance. You would want less exposure to equity investments or stock investments, right? It's not just time frame, it's also risk tolerance, right? If you cannot bear to see your investment potentially go down a little bit, the stock market isn't the place for you, because with investing in the stock market comes risk. So finally, understanding, you know, what your goals are, what you're saving up for, what your time horizon is, when you're going to need that money, and what your tolerance for watching the ups and downs are, you can determine an allocation. So I know myself, like I was telling you, pretty aggressive, not going to touch my money. So I'm even more aggressive than this aggressive portfolio. My retirement account is 100% stock right now. Again, I'm not going to access it for 20 years. I'm okay knowing that it can go up and down. The other thing with my retirement accounts, it's my 401k. It comes from my paycheck. So every time I get paid, I'm investing in it. So if the stock market is down, I like to think of it as buying something on sale, right? If I like a stock long term, if it's down today, I want to buy more of it, right? If a stock is $50 today, but tomorrow it's 30, I'd rather buy it at 30 than 50 if I still like the stock. So again, I am pretty aggressive. I have pretty high risk tolerance. Again, knowing I'm looking at the factors. You know, my goals are as much money for retirement as possible. My time horizon is over 20 years. I'm not going to need it to be liquid for at least 20 years. And I have a very high risk tolerance. So I'm okay being on the aggressive side. Going to the complete other side, the conservative portfolio only has a 26% allocation to stocks. The remainder of that being cash or money markets, like we talked about at the very beginning, cash on hand. Very, very low rate of return, if any, but it also has no risk associated with it, right? So that's the thing that you're going to be thinking of. Return and risk kind of go hand in hand. More risk, more return. And then in the red is this category called bonds. Now there's 2 flavors of bonds, and bonds at a high level is lending money to a corporation or a municipality or government. With that comes different trade-offs. If you loan money to a company, it's called a corporate bond. A corporate bond is going to have a little bit higher rate of return on it, but it is also that income is going to be taxable from a bond. So if I lend money to Apple, to Microsoft, to Dell, they'll pay a little bit more, but it's going to be taxable. If I lend money to the city of Plano, they are going to pay a lower return, but that money that comes back to me is going to be tax-free. It's called a municipal bond. Municipal bonds are tax-free. There's one in the middle called government bonds. And that's when you loan money directly to the federal government. You had heard of savings bonds or treasury bonds. Those are also taxable, but they are one of the most stable investments that you can get. If you buy a bond, at $100, on a new issue, you're going to get your $100 back with your rate of return, right? The U.S. federal government is the most stable investment that you can make because, as we've all seen, the federal government has the ability to issue bonds and increase bond issuance at any time to meet their obligations. So then if you look in the middle, the moderate portfolio is going to be somewhere in the middle at 50-50. In all the examples that I've been showing so far and talking about the stock market, they like to use the S&P 500 just as a general basis or index for the stock market. The S&P 500 is the 500 largest US companies. So pretty much anything that you can think of, it's on there. Again, your Apples, your Googles, your Microsofts, your General Motors. But stocks come in different flavors as well too. If you think of a utility company, right, like a Verizon or a bank or banks like Bank of America, typically very stable investments, pay a dividend, and don't necessarily grow as fast. If you think about smaller companies, like newly issued stock, that's going to be a little bit more aggressive. So even inside of all of these different categories, stocks, bonds, and even to some extent money markets, there's also different abilities to be more or less aggressive inside of those categories that are typically defined as aggressive. In general, your most aggressive stock investment is going to be in international small companies, right? Because number one, it's a different country, so we don't know exactly what's going on. And it is a small company, so we don't know how long they're going to be in business forever. But that being said, one of the best performing stocks has been Daikin. It's a Japanese air conditioning company, right? I'm not making this as a recommendation to buy that stock now. Just saying it started out as a small air conditioning company in Japan. But then when Europe, as the planet has been getting hotter, Europe has been wanting more and more air conditioners. A lot of those old stone buildings don't have ductwork for air conditioners. Daikin pioneered ductless air conditioning systems. So a lot of those got sold over there. And they do, I don't know if anybody's seen the A number one air commercials, the red trucks. They have Daikin stickers on their trucks now. So it's just one of these companies that was nothing for the longest time. Now they're an international air conditioning conglomerate, right? So would have made a lot of money if you had invested in Daikin years ago. The other thing that's important, past performance is not indicative of future results. And the best company that we like to think of there, particularly here in Texas, is Enron, right? Enron 20 years ago was one of the hottest stocks that everybody loved. Enron. They were in magazines. They were naming stadiums. They were having all kinds of stories written about them. This is how you run a company. And then turns out that all of their financial statements were falsified. So the stock went bankrupt and went to zero. So just because it was the best performing stock for so long doesn't mean it'll always be the best performing stock. So when we're looking at the allocations that we're showing here, that applies, number one, at your asset classes, but it also applies to the individual assets as well too. Companies have life cycles. They grow, they stop. And so as you're monitoring your portfolio, it's not just the mix as a whole. It's what makes that up as well. And that gets into this next one, review your investments regularly. With this comes a little bit of a caveat, right? You don't want to review all the time. Like you don't want to be looking at it every day. Like we saw, if you miss the best 5 days, your return goes down. If you miss the best 30 days, it goes down a lot. So I know day trading is a strategy that some people use, that some people have used successfully, but unless you have the ability and time and knowledge to dedicate yourself to day trading every single day, it's tough to be a day trader. I look at my own personal investments once a year. So it's, again, I have that long time horizon. I have that risk tolerance. I look at it once a year, and then at once a year, I rebalance back to what my categories are going to be. This is one of the most missed recommendations in the investment world, right? People love to think it's like gambling, like you're at the craps table, right? Oh, well, my stocks are going up. I want to stay in stocks. I want to stay in stocks. If you're here in this moderate portfolio and your stocks grow to 60, 70, 80%, right? Stock volatility hasn't gone down. Volatility goes both ways, right? Up is volatility also, but with up comes down. So if you say that you're comfortable here in the middle at a moderate portfolio, but you've let your stocks grow to 70, 80, 90% of your portfolio, you are no longer within your risk tolerance and where you're comfortable with your asset allocation. So that's one of the areas that people think, I'm just going to let it ride. Oh, I'm just going to let it ride. But that's how you get frustrated with your investments, because you're going outside of your discipline, going outside of your risk tolerance. The flip side of that, we talked about when stocks are going up. If you're comfortable at 60% equity, and we've had some bad years, and you go down to 40% equity, sell off some of the other stuff and buy back up to 60% equity. Because like we saw on the chart, over long periods of time, if you're going to be invested in equity, you got to be invested over long periods of time. So with downward volatility comes upward volatility again. And I'm going to go back to the chart too, because you can see it. With the sharp downturns also come sharp upward movements too. So if you say you're comfortable at 60% and just holding your stocks has gotten you down to 40%, you need to buy back up to 60%, because it's going to take forever just to get back up to 60 if you're not contributing to it and not staying within your risk tolerance. That's also what leads people to becoming frustrated or to fail from their investment plan, is if they stay outside of their portfolios and their risk tolerances. So one of the things that's been really popular recently are robo advisors. Essentially, the computer, you fill out a questionnaire, it determines what your risk tolerance is, and then it recommends investments. It usually uses low cost index funds, right? So you don't have to worry about what stock to pick. You don't have to worry about what bond to pick. It invests based on the questionnaire that you fill out, and then it rebalances for you. So it takes all the discipline out for you. If you don't have the discipline to monitor it yourself and to go in and to watch those investments, that might be a good option as well. A lot of people like to use financial advisors. That's a job that I've had at one point in my life. And so again, if you want that person to talk to get recommendations, to get feedback, you can reach out to call your advisor and ask what their thoughts are on changing or updating your investment strategies. And then finally here, as a best practice, one of the things that I do want to tell people, particularly, as they're starting out, people want to know where to start. What do I do? How much money does it take? If you are employed and your employer has an employer-sponsored retirement plan, those are typically stock market investments. A lot of times you might already be invested in one. A lot of employers are going towards automatic enrollment in retirement plans right now. So a lot of times just having a job means you are invested in the stock market. So that might be worth checking out with your benefits provider or your company. If they don't do automatic enrollment, sign up for it, right? Because one thing that's really popular in trying to attract employees is a 401k match. At the bank, they match 100% of the first 5% of my salary that I contribute, right? So that's a guaranteed dollar for dollar match on the first 5%. So if I contribute 3%, I'm just giving away free money that the bank wants to give me just for contributing to the retirement plan. So that's another way to help build up what your investments are. Is looking for what those different options are available to you. If you don't have an employer-sponsored retirement plan, obviously you can start. There's a lot of online places that you can go to, and there's obviously all of the different brokerages that are around as well too. But the real important thing is make sure when you're getting started, don't get sold a product. Like, understand what your risk tolerances are, understand how much you can contribute, and stick with your plan, and continue to invest in it. Now, I know with this topic, I did stay pretty high level. I know from talking, I think they're wanting us to go deeper into some of these topics later, didn't want to blow everybody out of the water on day one. So we will be coming back for future sessions to talk specifically about, stock investments or bond investments or mutual fund investments, things like that. But particularly with starting out, I know that tends to come with a lot of questions. So what I want to do is open up the floor for any questions, and I encourage anybody to ask any questions, because a lot of times, what we see is normally everybody's scared, but everybody has the same question, and then usually that'll get the ball rolling on some discussion here. And the other thing I'll say is this is typically when the best part of the presentations are, right? When you get your questions answered and people can kind of spitball off what those questions are. So I definitely want to hear what those are from anyone.
For those of you that are on the Zoom, you can just enter your questions into the chat box and we will ask them for you. Do we have any here in the room?
None yet. Well, then while we're queuing questions, so what I will say, when we are starting out, one of the best investments that you can make, I know I mentioned it, low cost index funds. In all the examples that I used, again, I talked about S&P 500, S&P 500. The only way that you can get that S&P 500 return is to be invested in the S&P 500. A lot of there's different ways to get to it. There's either mutual funds, or they're called ETFs or electronic traded funds, typically have a very low cost to get in and will deliver the exact performance of the S&P. So when you see those charts, that's the return that you're getting, right? Rather than having to pick or having to have the money to buy all of those individual stocks to make up all 500 that are in the S&P 500, you can get into it into a more cost-effective way. So I do see there's one question. It popped up and came down. Oh, now there's three. Excellent.
Okay, so the first one is, what do you think about biotech stock?
Biotech stock it's a great investment. We got a lot of stuff going on. With that being said, biotech does carry a lot of risk, right? When you think particularly of biotech, you're thinking of a lot of the new developing technologies, particularly as our population is aging, as we're seeing the pandemic and all kinds of new diseases. One significant medical advancement can be dramatically important. I don't know if anybody's bought medicine recently, but every time there's a new good drug, they maintain a patent on it for a large number of years. So if it's fantastic, I can say this, my daughter does take a particular medication, and it is like a car payment because it handles that particular ailment extremely well. So with that comes that ability to charge that. That being said, there's a lot of research and development that comes into the biotech space. If it fails, it is costly and you get no return on it. So you have a lot of upside in biotech stock, but with that comes a lot of downside as well. But that's a good question.
Okay, our next one is there a minimum investment that you would have to make?
So that depends on the investment that you're getting in and the firm that you are using to start your investments. I know a lot of the online places will ask for maybe a $500 or $1,000 investment, but a lot of times if you can commit to like a monthly $50 or $100, they will let you start at that $50 or $100 investment as long as they continue to know that you're going to make that contribution. So you can get started pretty low. I've also heard, I don't know of the success of them, but I know that there are some that start significantly low. I want to say Robinhood is one of them, or Acorns, where they'll round up the change from like ATM or debit purchases and use that to purchase investment. So those are other options as well too for low dollar amounts. You don't have to be a millionaire to get started. And then again, your retirement plans at work, right? Those are going to start with with contributions directly from your check. So a lot of times you won't even see that coming out. You had a question.
Stocks and cryptocurrency, basically the same thing?
Stocks and cryptocurrency are not the same. It's almost like there was a plan. I was waiting for the cryptocurrency question. So stocks are actual ownership of a company. When you own a share of Bank of America, of Levi Strauss, of Nike's, you are an owner of that company. You get to vote on some of the directions of the company. You participate in the earnings of the company. Cryptocurrency, the important part of that is currency. So it's when you think of dollars or you think of euro, it is essentially that. It is a currency. Cryptocurrency is not physical and it's not regulated. It's also not super secure. There's a lot of risk with cryptocurrency. So as we've been talking this whole presentation, risk and return go hand in hand. So there have been a lot of stories about people that have made a lot of money in cryptocurrency. There have been a lot of stories of people that have lost a lot of money in cryptocurrency as well too. The struggles with cryptocurrency is the wallet or location that you're holding your cryptocurrency secure? Because I know that there have been a lot of failures around that. It's very easy to steal cryptocurrency. And then the other thing, which one are you going to buy? It is not hard from what I've learned you can create a cryptocurrency and just put it out there and people will buy it. But how many of them are actually good? That's pretty limited. I've only heard of about 5 or 6, like over time. Like there's the Bitcoin, Ethereum, Litecoin. But there's another one that there was one that was based on an internet meme, right? People put 30 million in it, the thing folded, 30 million vaporized, went nowhere, right? And because with cryptocurrency, because you're not buying a thing that you can touch, I have never recommended anybody to buy cryptocurrency because the only thing that's going to make it appreciate is the next person willing to pay me more for it than I paid for it. Right? It's not something that you can touch. It's not something that you can go do, right? Like a Bitcoin isn't going to create medicine. It's not going to create a car. Right? It's like kind of like buying art, right? I mean, art only increases value because somebody wants to pay you more for it than you paid for it, right? But with art comes like, they're not painting any more Picassos or any more Warhols, right? So there's other factors that go into art that don't really go into cryptocurrency. It is hard to understand. It is hard to understand why it goes up or down. And with all that inherent risk, if you're starting out with a small amount of money, I would not recommend starting in crypto.
We have a few questions about ETFs. So the first one is ETF a good investment option?
Yes, ETFs are good investment options, but it's important to split out ETFs as the option versus what particular ETF you're buying. So an ETF is essentially a basket of stocks that trade on the stock exchange, right? So it goes up and down every day and it trades all day long. ETFs can be as broad as the S&P 500, like we've talked about, or I know that there is a cryptocurrency ETF. So speaking of that, so it's a basket of cryptocurrency. Understanding what that ETF invests in is critical to understanding whether or not it's a good investment or good investment for you. Also with ETFs, you need to understand what the fee structure is. The smaller an ETF is, the more higher a fee it's going to charge. So some of the big, and I keep talking about the S&P 500 one, I have seen it's called the expense ratio because somebody has to do the work of, monitoring that basket of stocks. I've seen some S&P 500 ETFs charge as low as 0.04% as a management fee. That's about as cheap as it's going to get. But some of the more, I think on some of the crypto ones, I've seen them be as high as 5%, right? So that's 5% that you're losing just to have someone watch that basket for you. So you have to return at least 5% just to get to zero. So with ETFs, they are a good investment because you're buying a basket instead of one individual stock or bond or cryptocurrency, but with it comes the risk inherent with that particular asset class or basket of securities as well too. So with an ETF, make sure that you understand what you're investing in and what your expense ratio is.
Okay, and then somebody else asked, how do you identify, I guess, which ETF gives like high yield?
So there's a couple of different ways. One is by name. A lot of times they will say high yield equity, high yield bonds, high yield savings. They will call it by name in high yield because that is, a attractive asset class, right? People have been wanting to have more yield. The other thing, when you are researching them, you look for, it's called the dividend payment. And sometimes it's quoted in a percent. Sometimes it's quoted in actual dollars and cents. So if it's quoted in a percent, you look at the price of the ETF, multiply by the dividend percentage. That's what you will get a year as a dividend payment. If it's quoted, in dollars and cents, you multiply that by the number of shares that you have, and that's how much in dollars and cents you will get a year. A lot of the screeners, like Yahoo Finance, or a lot of the online brokerage companies will allow you to search for ETFs and by different criteria. So you can look at, what type of index it follows, or what type of dividend it pays, or what kind of yield it pays. So that's another way to be able to look for those high yield ETFs.
So one of our participants says that their intention is to invest portions of their Roth IRA funds into dividend ETFs.
And that is a good strategy. So when we were talking about taxability earlier, so dividends are taxed at 15%. So, when you think about your income, it's on that graduated scale, depending on, how much money you make, you go to a different tax bracket. Dividends are taxed at 15%. So whatever you make in dividends, in equity dividends, it's taxed at 15%. A Roth IRA is a good place to do that, because with a Roth IRA, those dividends are not taxable when they post to your account, and they're not taxable when you withdraw them after age 59 and a half. So you kind of get that double tax-free benefit. So that's a good strategy that participant shared. Thank you for that.
Somebody wants to know what the difference between ETFs and mutual funds is.
It's a good question. They are very similar vehicles. They are both baskets of securities that are meant to provide diversification just with one investment. A mutual fund is priced and traded at the end of the day, and you purchase mutual funds in dollars. So typically you're gonna say, I'm gonna put $1,000, $5,000, $10,000. It's priced at the end of the day. It trades once at the end of the day. So if you want to buy a mutual fund or sell a mutual fund, you do not know the price you got for it until the next day. An ETF it's similar. It is a basket of investments, but it trades on the stock market, and it trades when the stock market is open. And it trades in shares. So you have to know the prices. So if you want to invest $10,000, it is very hard to invest around $10,000 in an ETF, because it's going to be priced. It's going to go up and down as the stock market goes up and down. But the flip side of that being, if you want to sell your ETF, you sell it right then, you know exactly what you got for it. It prices right there on the stock market. But it's essentially two different flavors of getting the same diversified basket of securities. Mutual funds tend to have higher fees too.
Will a future class go in more detail on how to choose bonds for your portfolio?
So I have to be careful on how I answer this question. So I am not a licensed securities professional, so I cannot make recommendations. There will be a future class on the specific differences between the different types of bonds, but I cannot make a recommendation on what would be a good purchase for your portfolio. But we can talk about all the different flavors and the pros and cons.
Okay, so then this is a different person asked, but it's a good follow-up. As a conservative investor, what types of investments would you recommend? Is that going to be more mutual funds or bonds?
So a lot goes into that, and a lot goes into what the definition of conservative is, right? So in general, broadly speaking, a conservative investor will have more bond and cash investments, and the equity investments that they have will be lower volatility, kind of the high yield equity investments. So that being said, a conservative investor, it's never really a set it and forget it, right? Because sometimes you want to, I would say start overly conservative. And then if you are wanting more return or feel comfortable taking more risk, you can purchase more equities or get more aggressive with your allocation slowly. Because the other thing that I've learned through all of my years, people remember losing money more than they remember making money. I have never heard anybody say, I made 100% on that stock, but I have heard people all day long talk about, oh, I lost all my money in this stock and I lost all my money in that stock. So part of it is the just kind of the psychology of it, you know, and the human brain. We are more averse to risk than we are rewarded by a positive outcome. So if you're saying that you're conservative, I would recommend starting out more overly conservative rather than starting out overly aggressive.
Someone would like to know, how do you contribute to their IRA if they have a pension?
So that's a good question. So an IRA, so there's two flavors. There's a traditional IRA and a Roth IRA. A traditional IRA requires you to have earned income to be able to contribute, because the contributions to a traditional IRA are tax deductible. If they are drawing on their pension or have no earned income, you can contribute to a Roth, but there are going to be potential limitations on those tax-free benefits that we talked about earlier. You know, it is best to talk to a financial professional on what your exact situation is to see if those are going to be good choice for you, you know, depending on if you're drawing your pension currently.
Is AI technology stocks promising any returns since the world is slowly moving towards AI?
So again, understanding the different, you know, kind of demographics of the world and the ups and downs of the economy, those are all good technologies, you know, to look at. You know, that being said, there is a lot longer lag time with some of those. We tend to get the news story before the technology takes over, right? And the best one that I like to think of is electric vehicles, right? I mean, Tesla is a good story, but with all of the promise that we've heard about, so much of the vehicle fleet has to be electric by a certain time, and car manufacturers have to get so many MPGs and going towards electric vehicles to make that happen. You know, a lot of times it doesn't happen as quickly as the news gets out. So do the research on the individual stocks, understand what you're buying, and again, make sure that you are not, you know, putting all of your eggs in one basket.
Okay, and our last question, and I saved it for last because I think it was a great one. What would you advice would you give for young adults who want to start investing?
That is a great question. For young adults, my recommendation, and it comes with a lot of these, it's pay yourself first. If you have a job, if you're working a summer job, if you have an after school job, take 10-15% of your paycheck every time, put it towards some kind of savings or investment, and make that a habit. Because before you have bills, you just get used to that 10-15% coming out of your check and going towards an investment every time. And then as you get older and still have that habit of putting that 10-15% away, you're still investing. On top of that, the earlier you get started, the longer the timeline you have. So kind of going back to this chart here, right? This is a 22-year chart, right? So you're looking at this, you know, even with all those downturns, you know, you get pretty good return, just staying invested. You know, if we go down to the next one, over 31 and a half years, if you stay invested over 31 and a half years, you get a 9.8% return, at least over the last 31 and a half years, as shown by this chart. So the earlier you can get invested, the longer you can stay invested, and the earlier you can make it a habit, is the best way to success in the future. As a parting, one of the things that I learned early on in this business, when you look back over your investing history, the majority of the money in your investment account is going to come from what you contributed to it, right? It's not going to be the growth of it. The more that you can contribute, that's the discipline that really makes money grow. It is very rare that someone becomes a stock market millionaire off one single investment. It is the discipline to keep investing and to stay invested over those long periods of time. But that was a great question.
Gotten any more questions from the Zoom? Did y'all think of anything you want to ask? Okay, we'll stay open for a couple more minutes just in case you have any other questions that you would like to ask. Otherwise, thank you so much for attending tonight. We will have more financial literacy programs. You check out the Engage brochure or online at plano-library.org. We have our calendar there, and you can look at all of the programs and events that we have coming up. And thank you very much for joining us tonight.
Is that one new question?
She said, thank you. This is a great learning opportunity.
Of course.
Oh, we did get another question.
Okay.
Is there a safe proportion of investment between ETFs and stocks?
So ETFs are made up of stocks. So what I would say is if you are balancing your portfolio between ETFs and stocks, understand what stocks are held by that ETF and don't buy those same stocks, because then in essence, you're just adding to what you already have. Remember, an ETF is a collection of other investments. So if you have an ETF and then turn around and buy the same things that are held in the ETF, you are not adding to your diversification. But that's a good question.
So thank you so much for this webinar. It was very informative.
Excellent.
If we have no other questions, thanks again for joining. We will see you next time.